So good morning, one and all present here. Welcome to the class on investment management. If you remember in the previous class, we were discussing about minimum risk portfolio. So minimum risk portfolio is one of the concept from which you definitely expect question in exam. So what happens, like suppose if I have a two stock, suppose if I have a two stocks like this. Suppose if I have a two stock portfolio like this, suppose if I want to create a two stock portfolio like this. So if I want to create a two stock portfolio like this, then the thing what matters here is that you want to create a portfolio of the two stocks. You want to create a portfolio of the two stock, and now when you have two stocks and you want to create a portfolio of these two stocks, so what matters here is that what percentage of money you put in stock A and what percentage of money you put in stock B. So the purpose of creating a portfolio, the whenever you create a portfolio, so whenever we are creating a portfolio, the purpose of creating a portfolio is to minimize the risk on the investment, is to minimize the risk on the investment. So whenever we create a portfolio, the objective what we have is to minimize our unsystematic risk investment. So you remember already yesterday and day before yesterday when I took the class, I told there is a form of risk which you can minimize, which is called as unsystematic risk. So what we try to do whenever we talk about portfolio creation, we try to create a portfolio. Thereby, we want to minimize the total risk on our portfolio. So imagine if you have two stocks. Imagine if you have two stocks, like stock A and stock B. Their returns are given to you. Their standard deviations are given to you. You can find their variance by taking the square of the standard deviation. You can find the variance, and also you can find the covariance between them if coefficient of correlation is given. So in this problem, coefficient of correlation was given to us, that the coefficient between x and y was given to us as zero point 0.5. The coefficient of correlation was given to us as zero point 0.5. Okay. So I want to create a portfolio of stock A and stock B, and we know that we should create a portfolio so that our total risk on our portfolio should be minimum. Okay. So now what I can do, I can change in order to check like what should be the weight, how much money should I put in stock A and how much money should I put in stock B, so that my total risk should be minimum. Suppose that is my objective. I want to create a portfolio stock A and stock B, so I can put any amount of money in stock A and the other part of money in stock B. And thereby, I want to make sure that my total risk on my portfolio is minimum. Different investors, when they invest their money in stock market, they invest their money based upon different objectives. Some people who invest their money in stock market, they look for high return. So they look for high return. So though for that, they try to choose that kind of portfolio which is more risky. So more risk, more return. Some kind of investor don't want to take more risk. So as a portfolio management, when we study, we believe that the investors are in portfolio management. When we study, we believe that the investors are risk averse investors. So investors are risk averse. Risk averse means they want to minimize their risk and they want to maximize the return. So we believe that all the investors who look for investment in the stock market, they want to make sure at the minimum possible risk, they should get the maximum return. So that is the assumption what we believe whenever we talk about portfolio management, is that the investors are risk averse. Okay. So imagine if I give you two stocks. Imagine if I give you two stocks, A and B, and I want to know how much money should I put in A and how much money should I put in B. Suppose if my objective is to minimize the total risk on the portfolio. While what is weight of one? Weight of one means the money invested in stock A, weight of money is the money what you invest in stock 1 divide by the total investment. Divide by the total investment. That is weight of 1. Okay. While weight of 2 means the money what you'll invest in the money what you'll invest in the stock money what you'll invest in the stock to divide by the total investment what where your total investment is the money what you put in stock 1 and stock 2 where you know that the weight of 1 plus the weight of 2 that is equal to 1. Okay. So here when you are trying to create a portfolio where if I give you the return, if I give you the return on each stock, if I give you the risk on each stock, if I want to create a portfolio, so what you do, you can use trial error method, and like you can you can change the weight. Here I took 100% on A, 0% on B. Here I took 90% on A, 10% on B. Here I took 80% on A, 20% on B. Like this, I can change the weight of A and B. And by changing the weight on A and B, what I'm trying to do, I am just checking what return I'm getting and what is the risk on the portfolio that I'm calculating. To calculate the return on the portfolio, you can use the formula. This is the formula for the return on a portfolio. Okay. So this is the formula to calculate the return on the portfolio. While to calculate the risk on the portfolio, we use this formula. Okay. So to calculate the risk on the portfolio, we use this formula. Okay, so you know this formula to whenever we talk about the return on a portfolio, whenever we talk on the risk on the portfolio, you know this formula. So the two portfolio, we already we have discussed the risk and return based on this formula. So what I did, I just keep change the weight with the weight. What is the return I can get? What is the risk I can get? That I have checked. Okay, so this is the one way this is the one way through which you can calculate you can figure out by trial error method. You can figure out what is the risk on each stock, what is the risk on the portfolio, and you can see where is the minimum risk. You can see where is the minimum risk. I can see where is the minimum 22 21, then 21 5. So the minimum here I can see zero point 0.7 on A, 70% of money on A, 30% money on B. So like this I can see here. So I got a fair picture like this. So but is this the exact amount of money should I invest on, or is this the minimum risk? Is this the minimum risk? The question arises when I see this data. Is this the minimum risk? Is this the minimum risk, or the risk can be more minimum than this? Okay, something like that. So basically, the mathematically you can find out this in using trial error method. Mathematically, you can find out this. So what I told you for the minimum risk portfolio yesterday, I told you the formula for the minimum risk portfolio. So that formula was weight means the weightage of money what I put in stock A, that should be equal to the variance on stock B minus the covariance between stock A and stock B divide by variance of stock 1 plus the variance of stock B minus 2 types of covariance of stock 1 and stock 2. Okay, this is the formula what you can use. Then the weight of money in stock B is 1 minus the weight of money what you put in stock A. So this is the formula what you can use. Please switch off your webcam. I don't know, someone has switched on their webcam. So the weight of money I put in stock A is I can determine by this formula. Weight of money what you put in stock B I can determine by this formula. So don't waste your time finding trial error method. What can be the weight and where you can get the minimum risk and all. Instead of doing that, you can just simply use the formula. Okay, covariance in some books and all. If you notice, they will write the same formula. They'll write like this: variance on 2 minus standard deviation of 1 into standard deviation of 2 into coefficient of correlation between 1 and 2 divide by variance of 1 plus variance of 2 minus 2 times of standard deviation of 1 into standard deviation of 2 into r of 1 into. I hope you will not get confused. I hope you remember that the covariance between 1 and 2 is the coefficient of correlation between 1 and 2 into standard deviation of 1 into standard deviation of 2. You know this formula very well. So you will not get confused. So then by using this formula, what I did, I found the variance on one. By using this formula, I found the variance, I found the weight of one, where how much I invest on money on one. Then one minus the money you put on one, that will give you the weight of two. Okay, and then what I did, I calculated my return, I calculated my risk, I calculated my risk on that. So this is the standard deviation on that. So this is my standard deviation on my portfolio. So this is the minimum what you can get. This is the minimum what you can get, which you can see here. So you can see this, which is lesser. You can see this and this. So this is the minimum risk what you can get. This is the minimum standard deviation value what you can get here. So this is the weight. So at this weight, so the actual weight is not zero point 0.7 and 0.73. The actual minimum weight is 0.69 and 0.3094, where your minimum standard deviation you are getting this much. So mathematically, you can calculate everything by using this formula. So you just need to substitute this value here in this formula. You will get this answer. So I hope you are clear with this. So whenever you talk about two stock portfolio, whenever I talk about two stock portfolio or two asset portfolio, whenever I talk about two asset portfolio, whenever I talk about two asset portfolio, the return on the portfolio, the return on the portfolio, if I talk about two stock portfolio, the return on a portfolio is summation of weight of money I put in stock A into return on stock A in plus weight of money I put in stock B into return on stock B. While if I talk about the risk on a portfolio, while if I talk on the risk of a portfolio, that the risk on a portfolio, if I talk about that, is the weight of W1 square into sigma 1 square plus W2 square into sigma 2 square plus 2W1 W2 into covariance between 1 and 2. This is the formula for the risk on a portfolio, or you can write the standard deviation of portfolio is the formula W1 square sigma 1 square plus W2 square into sigma 2 square plus 2W1 W2 into covariance between 1 and 2. So understand this formula. Okay, so so you understand here in this formula, if the coefficient of correlation between the two stock become plus one, in this formula, if the coefficient of correlation between the two stock is plus one means coefficient of correlation. If the coefficient of correlation between the two stock is plus one, it means there's no point of creating portfolio. If their coefficient of correlation is plus one means both of them change will move exactly like each other. So there's no logic of creating portfolio. Whenever you create portfolio with that intention that somehow you have to minimize the risk. But if the coefficient of correlation between the if the coefficient of correlation between the two stock is plus one, what that mean? That means you can see here W1 square plus sigma 1 square plus W2 square into sigma 2 square plus 2W1 W2. You know that covariance formula is sigma 1 sigma 2 into R of 1 2. And if R value is plus 1, if R value is plus 1, then the standard deviation of the portfolio would be W1 square sigma 1 square plus W2 square into sigma 2 square plus 2W1 W2 sigma 1 sigma 2. So if you notice this is the equation of a square plus b square plus 2ab. If you notice, this is the equation of a square plus b square plus 2ab, which is equal to a plus b whole square, if you understand. So ultimately, so if the coefficient of correlation between the two stock is plus 1, then the standard deviation of the portfolio would be W1 sigma 1 plus W2 sigma 2 whole square. So it means that if the coefficient of correlation between the two stock is plus 1, then the standard deviation of portfolio is W1 sigma 1 plus W2 sigma 2. So means it is the maximum risk. It is the it is the maximum risk portfolio. It is the maximum risk portfolio because you can see that it's some total of that value. So so that means there's no logic of creating a portfolio. So there's no point of creating a portfolio like this way. So the purpose, we create a portfolio with the intention to minimize the risk on the portfolio. But if you choose two stocks which are exactly 100% replicating each other, then there's no logic of creating portfolio and your risk is also not getting reduced. So, but that's why I told you whenever you create a portfolio, you have to make sure that the portfolio, the coefficient of correlation between the two stocks in the portfolio should be minimum. Okay, so remember this. While while if I talk about like the case, while if I talk about the case when the coefficient of correlation is -1, W1 square plus sigma 2 square plus W2 square into sigma 2 square plus 2 W1 W2 sigma 1 sigma 2 into R of 1 2. Like if the coefficient of correlation between the two stock is -1, then the standard deviation of portfolio is W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 sigma 1 sigma 2, and R value if I take -1. So the standard deviation of the portfolio is W1 square sigma 1 square plus W2 square sigma 2 square minus 2 W1 W2 sigma 1 sigma 2. So the standard deviation of portfolio is square root of W1 sigma 1 minus W2 sigma 2 whole square. This would be in the form of A square plus B square minus 2AB. Uh, so, uh, so, 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 so the here the standard deviation of the portfolio would be W1 sigma 1 minus W2 sigma 2. So this would be the standard deviation of the portfolio. This would be the standard deviation of portfolio. You can see you're getting the minimum risk here. So if the R is -1, you can see this is the ideal portfolio. This is the ideal portfolio what you can get. This is the ideal portfolio what you can get. This is the ideal portfolio what we can get. So this case happens if the R value is -1. This happens when the R value is -1. So that's why getting the portfolio where the R is -1 is next to impossible. So, but even then, the perspective what the investors need to keep in their mind whenever they create a portfolio is to make sure they have to minimize the risk on the portfolio. So choose those stocks in the portfolio which are negatively correlated. I hope you got the logic. Anyone have any doubt? Anyone have any logic? Sorry, anyone have any doubt? Any doubt, anyone? So if you are clear with this, then we'll solve this problem. So already here I discussed the theory part, that if you see this question number 6, the part A, I talked about, like question number 6, part A, I talked about the three levels of market efficiency. I told you there's an economist called Eugene Fema. She proposed a theory which is called efficient market hypothesis. So, as per the efficient market hypothesis, no matter what form of portfolio diversification you do, but you can never able to beat the market. The return what the market gives you, that is the best return. So, as per the Eugene Fema, the return what you get from the stock market, the return, that return is the best return, that no investors can beat the market. But we know in reality there are a lot of fund managers are there who create their own portfolio, and by doing so they able to beat the market. So in the market efficiency theory, you need to talk about the three forms of markets. Either it can be strong form or semi-strong form or weak form of the market. Remember that part. Okay. Now we have done the part A. We have done the part B. Determine the minimum risk portfolio. That part we have done. Now we'll do part C of this question. You have stock X and stock Y. Their return from the last 3 years is given to you. Find each stock expected return and standard deviation. And then we'll do the next part. What is expected return and risk on the portfolio made of 40% in X and 60% in Y? Okay, so let's do this problem. Question number, part C of question number 6. So you have two stocks, stock X and stock Y. You have two stocks, stock X and stock Y. I need to find each stock expected return and standard deviation. Okay, so I need to find each stock. So, so return on stock X and return on stock Y. Each stock are given to me. Each stock are given to me. So the returns are given to us. Return on X. So return on X and return on Y, both are given in percentage to you. This is 10, 18, 8. This is 10. This is 10, 18, 8. This is 10, 18, 8. 16, 12, 14. 16, 12, 14. Find each stock expected return standard deviation. Okay, so now this data is given to us. Now this data is given to us. Okay, two stocks are given, stock X and stock Y. So I can find the sum. So what is the sum? I'll get 36 now. Beat it. Sum I get 36. Here the sum 42. Here the sum is 42. So the average I can find. Average I can find 36 by 3. This is 12. Here I can find the average. This is 14. Okay, the average return. So here the sum correct now, 28 plus 8, 36. Here this is 28, 30, 42 correct. Okay, so now I can find the average return. Okay, so this is return on X, this is return on Y. I found the average return. Now what I want, this is the average return I got. So they want their average return. They want their average return. And after that, what they want each stock expected return means average return. So here, these are historical data, understand these are historical data. Understand these are historical data. Understand these are historical data. So whenever you get a historical data, then the return on the data, return, average return, whatever you say, average return would be the sum of the data divided by the number of data. Okay, while its deviation would be either use the formula sum of x square by n minus x bar square, or use the formula called sum of x minus x bar whole square by n. So you use this formula whenever historical data is given. You can use the return, average return, by using the formula called sum of data divided by number of data. So here I did the same thing. I found the sum 36 and 12, and I divided by the, here total data is 3. So I divided 36 by 3. So here I divided 36 by 3 because 3 data is given. Here I divided 42 by 3 because 3 data is given, to find their average. So whenever historical means, I hope you understand the term historical. Historical means history. So whenever historical data is given, you calculate the return by this formula. You calculate your standard deviation by this formula, and you will calculate the covariance. You will calculate the covariance by this formula called summation of x minus x bar into summation of x minus x bar into y minus y bar by n, or you calculate the covariance by the formula called summation of xy by n minus x bar into y bar. Use any formula, you will get the covariance, standard deviation, all that. You can do that. While for coefficient of correlation, we you can use a formula called, you remember, no, n of summation of xy minus summation of x into summation of y divide by square root of n summation of x square minus summation of x whole square, then n summation of y square minus summation of y ka whole square. You remember, no, this formula. All these formulas you can use. All this formula we have already studied. So whenever historical data is given, you can use this formula to calculate their values. Whenever the historical data is given, you calculate your values by using this formula. The purpose here is that, depending on, in some problem data will be given, in some problem data will not be given. So how we can solve them? So how we can solve them? That is the point here. So that is the point here. So here, to calculate the average return, I'll find the sum on the data. So the sum on the data is 36. Here the sum on data is 42. Then average, if I want, because historical data is there. So the average here is 12. Here the average is 14. Okay, once you get this, now I want the standard deviation. So for getting the standard deviation, I can use anything. I can use any formula. So, so here, if I use the formula here, this is x square 100. This is 324. 8 square is 64. Okay, so then summation of x square, this is 8. Summation x square, this is 8. Then this is 8. Then this is 488. So this is 4 plus 4, 8. 6 plus 2, 8. 3 plus 1, 4. Then y square, 256. Then 144. And then 196. So this sum is 400. This sum is 400. This sum is 400 plus 596. So this is the sum on y x square. This is the sum on y square. Okay. Then what I can do, I can find the value of x into y. X into y, 160. This is 18 into 12. 12 into 18. So 18 into 12 is 36. Then 18, that is 216. This is 216. Then 14 eights are 112. Okay, so you can find the sum on them. You can find the sum on them. This is this is 8, then this is 8, then this is 4. So just check any mistake is there in calculation part, everyone. Just check these values. Just check in if you find any mistake anywhere. So 12 into 18, 216, 14 is a 1128, then 6, 7, 8, then 2, 2, 3, 4, then this is 10, 16, 1 carry, 10, 19, 1 carry, 2, 3, 4, 5. Then this is 8, then this is 8, this is 8. Okay, fine. So once you get this value, I can find the standard deviation on x. Standard deviation on x is summation of x square by n minus x bar square. So the standard deviation on x, so the summation of x square is 488. 488 by n. N means total, n is data is 3 minus x bar. X bar is 12. 12, no? X bar is 12. You can see x bar is 12. 12 square. So this will give you the standard deviation on x. So the standard deviation on x is, this is how much? This is 16. This is 20, right? This is 1. Then 1. So you get 1, 6, 18. Then 2 means 20. 162.67 minus 144. So the standard deviation on x you get is how much? This is how much? 0.67. Then this is 8. Uh, this is 8, and then this is 5 minus 4, 1. Okay. So 8 root of 18.67. You can do this. The root of 18.67. Root of 18.67. So here uh, root of 18.67, if I want, this is 162.67 minus 144. So this is standard deviation on x equal to 4.32087. This gives you the standard deviation on x. Okay. So now you can find the standard deviation on y. Standard deviation on y is again the same way, summation of y square by n, summation of y square by n minus y bar whole square. The standard deviation of y is summation of y square. Summation of y square is 596. 596. So 596 by n is 3 minus y bar. Y bar is 14. 14 square. So standard deviation on y is how much? So this standard deviation on y is how much? This is square root of 596 divided by 3. 596 divided by 3 minus 196 minus 196. So 596 divided by 3 minus 196. You are getting a value called 1.6329. So let me confirm. 596 divided by 3 is 198.66. 198.67 minus 196. So 14 square 196. So you get this minus 196. 2.66. 2.67. So square root of 2.67, that is 1.60. Okay. 1.63. Okay, correct. So you got the standard deviation of x, you got the standard deviation of y. So I found the standard deviation of x and y by this formula. You could have used the other formula also, square root of summation of x minus x bar whole square by n. Anything you would have used, doesn't matter. Anything you use, you'll get the same answer only. Anything you use, you'll get the same answer only. So this is the standard deviation of y. Then you can find the covariance between x and y. So the formula for that, summation of xy by n minus x bar into y bar. So the covariance of x and y, summation of xy already you found, that is 488. This is 488 y n is 3 minus x bar is 12, y bar is 14. So you can solve this. This is 488, this is 162.67 minus 12 into 14. 12 fours are 48. 12 into 14, 48, 168. This is 168. This is 168. This is 168. So if you subtract this 162.67, 162.67 minus 168, you get minus 5.33. So this is the covariance between them. This is the covariance between the two stars. So you can use this. You can get the answer like this. Okay. So just see this. Anyone have any doubt? Tell me. Any step? Anyone have any doubt? Anyone? Any step you have doubt? Anyone? Any step you have doubt? Tell me. So I can confirm my values. 10, 18, 8. 10, 18, 8. So I can confirm my values. So return on x, return on y, x is 10, 18, 8. Okay, y 16, 12, 14. 16, 12, 14. Okay. So what is the standard deviation? So what is the standard deviation on x? 4 point standard deviation on x, 4.3049. So 4.30. So you can see that 4.32, okay, 4.32049, 4.39 correct only. Now, if I find the standard deviation of y, that is 1.62, 1.6329, 1.6329 correct only. Now, covariance between them, covariance between them, comma, covariance between them, that is minus 5.33. So you got minus 5.33. So every data is correct. Nothing to worry. Every data is correct. Now what is required for me? What is required here in the question, that find the each stock expected return and standard deviation. Then what is the expected return and risk on the portfolio if it made of 40% of X and 60% of Y. So if I make a portfolio with 40% of X and 60% of Y, what is expected return and risk on the portfolio? So now you know that based on the output what you get. Now based upon the output what you get, you know that you have two stock A and B. You have the two stock A and B. Now what is the average return on the each stock? So the average return on each stock for X is 12 and Y is 14. X is 12 and Y is 14, while the standard deviation while the standard while the standard deviation is how much? X is 4.32087 and Y is 1.6329. Okay, you can do the square. Okay, and then you can find the variance. So the variance on them is how much? The variance on them would be the square of this. Just do the square of this. Just do the square of them. Just do the square of them. Just do the square of them. 18.6667. 18.667. This is 18.6667, while the variance of on another stock is 2.6667, while the variance on 2.6667, 2.66667. So this is the variance, while the covariance between them, you got covariance as minus 5.33. So while the covariance between them is minus 5.33. Now, if I create a portfolio, if I push, you're creating a portfolio, where you're putting 60% of money in X and 40% of money in X, 60% of money in Y. If I want to create portfolio, if I want to create a portfolio, uh, create an if I want to create a portfolio where I'm putting where my investment in X where my investment in X is 40%. If I'm creating a portfolio where my investment in X is 40%, investment in Y is 60%, and investment on Y and my investment on Y is 60%. Okay. Then if I want to create a portfolio where I'm putting 60% of money in X and 40% money on Y, then the return on a portfolio, if you want the return on a portfolio, so then your return on a portfolio is equal to sum of WI into RI. Then your return on a portfolio, so means how much money you're putting on X, 0.4. What is the return on X? Return on X is 12%, plus how much money you're putting on Y, that is 0.6, and return on Y is 14%. What is the return on the portfolio? 12 fours are 48, plus 14 6 are 84. This is 13.2. No, this is 13.2%. This is the return on the portfolio. So if I want to create a portfolio where 40% of money I'll put on X and 60% of money I put on Y. So this will be your return on a portfolio. I hope you understood this. Okay. Already from last so many classes we are doing similar kind of numerical. I believe you are understanding. While the risk on a portfolio, if I want to calculate the risk on a portfolio, so the formula for the risk on a portfolio is equal to W1 square into sigma 1 square plus W2 square into sigma 2 square plus 2W1 W2 into covariance between 1 and 2. you can find the risk on the portfolio. So, so here W1 weight 40%, 40% of money on stock A. Now risk variance of this is 18.67, 18.67 plus weight on 2.6 square into this is 2.67 variance on 2 plus 2 into 0.4 into 0.6 into covariance between 1 and 2 is minus 5.33. You can solve this. So this is 0.16 into 18.67 plus this is 0.36 into 2.67. Here minus sign will come. This is 2 into 0.4 into 0.6 into 5.3. Now you can solve this. So the standard deviation on portfolio, if you want to find this value, what is this value? So what is this value? This is 0.16 into 18.67. So you'll get 2.9872. This is 9872 plus this is 0.36 into 2.67. This is 0.9612 minus 2 into 0.4 into 0.6 into 5.33 into 5.33. So this you'll get is 2.5584. So 2.9872 plus 0.9612 minus 2.5584. This is root of 1.39. So the standard deviation of portfolio. So the standard deviation of portfolio is root of 1.39. That means 1.17898. This is the standard deviation of the portfolio. So by this you get the answer. Clear? Anyone have any doubt? Anyone have any doubt? Anyone have any doubt? 0.4 square into this x plus 0.36 square into variance of y plus 2 times of 0.4 into 0.6 into covariance between 1 and 2. 1.177. Correct one. Anyone any doubt? Anyone any doubt? If you don't have any doubt, then I'll wind up the class. Any doubt, anyone? भावना, चैतन्य, दिव्या, गीतांजलि, हरीश, कार्तिक, मोहन, पवन, प्रकृति, प्रियंका, राकेश, रंजिता, रवि, तेजा, रेडमी, संजय, शाकिब, सूरज, वीरेंद्र, योगेश्वरी, विद्या. Any doubt?